Hello folks, today we are going to discuss something about the large debt driven US economy. So what all you will learn in this, what is financial repression, how is it used to cut down the debt of a country, here we will talk about US, what is yield curve inversion, how is it related to a recession, what is the relation between financial repression and yield curve inversion, we as investors, how will we shield ourselves from this probable recession and financial repression and the aftermaths of this financial repression, and how will we save our portfolio and still create sensible profit even under this immense economic pressure.
Every single day in 2026, the United States government will borrow roughly $7 billion to cover the deficit, or nearly $5 million every single minute, and that borrowed money will add on to a massive mountain of debt.
The U.S. national debt has soared to a staggering $39 trillion as President Donald Trump unveils his fiscal year 2027 budget. At the same time, he is proposing the largest defense spending surge since World War II, $1.5 trillion total, including $251 billion in base spending and $350 billion through reconciliation, while cutting non-defense programs by just $73 billion. Experts warn this adds more than $3.2 trillion in defense spending over the next decade. Economists say Trump's military buildup directly contradicts his campaign pledges of no foreign wars, no adventurism. Steve Hanker of Johns Hopkins University calls it massive militarization, completely the opposite of what he promised MAGA supporters. Meanwhile, programs like Medicaid, Medicare, and daycare could face deep cuts to fund the defense surge, hitting ordinary Americans hard. CRFB President Maya McGuineas criticized the absence of top-line deficit figures, while White House projections assume 3% GDP growth over a decade, a highly optimistic scenario. Social Security faces insolvency, and debt servicing approaches $1 trillion annually. The U.S. military campaign in Iran has already cost $45 billion in just over a month. Gas prices have jumped 33%. Markets have tumbled, and Trump's approval ratings are slipping. Hanke calls it a plowshares into swords moment, converting a peacetime economy onto a war footing. Watchdogs warn the budget could create an unaccountable Pentagon slush fund and destabilize the nation's finances. Federal Reserve Chair Jerome Powell cautions, it will not end well if we don't act soon. The U.S. faces historic military and fiscal peril under Trump's proposed budget.
The ongoing war, America's national debt crossed $39 trillion for the first time. The debt has nearly doubled since Trump first took office in January 2007. Notably, this comes just 2 weeks before the 10-year anniversary of President Trump's 2016 promise to end the country's debt within 8 years. The U.S. national debt hit $38 trillion 5 months ago and $37 trillion 2 months before that.
We all know that US is under a large $39 trillion debt. Though it is the largest economy in terms of GDP in the world, its debt is also at the largest, which is around $39 trillion and still counting. So we know that US has been trying to dominate over the oil production so that the world economy is under him and he'll be able to have a dominance of its US dollar trades all over the world so that the US economy sustains, and if the US dollar is dominant, then his $39 trillion debt will not lead him to an economic crisis. But then it seems that the US-Iran war has been a total failure as far as US is concerned, and then whatever he tried to achieve out of that didn't happen, unlike what happened in Venezuela, Iraq or other nations wherein he was successful in introducing its dominance and still maintain the US dollar dominance. So now the $1 million question, what happens to the $39 trillion debt of US? The US keeps on increasing their debt ceiling, which is the highest limit of debt which the US can take. So that every year they keep revising so that their debt has reached at an all-time high of 39 trillion. Now, how are they going to service this debt? Now, the another question here is that will US slip to a recession? I have done enough video on this, but recession is nothing but 2 consecutive quarters of negative GDP. Like the GDP keeps on going down. It will have a degrowth quarter on quarter. But this is immaterial now. We'll concentrate more on the debt portion of that and how US is probably going to service this debt. If you see the debt to GDP of US has grown much above 125%, which is much above Warren Buffett standard value of around 80%. So this shows that the nation has gone much beyond what it produces. Means GDP is the gross domestic product of a country, means it's a sum of what it produces. And debt is what it takes to produce. A country needs to take debt to grow, and the growth is calculated in terms of GDP. So hence this ratio of debt to GDP. So if the debt is high and if the GDP is sensible, say debt to GDP is around 80-85%, India fits there. So it is justifiable. But about 125% is such an alarming value. So as we speak, for a $39 trillion debt, US is paying around $1 trillion interest payment every year. This has in fact exceeded their military spending as well. This is so much alarming. So now there is a fight between US President Donald Trump and Jerome Powell. He is telling that Jerome Powell, the current Federal Reserve Chairman, he should be removed. But then now by May 15th, 2026, this Jerome Powell will step down because he has completed his tenure, and the new Fed Chairman, which is in fact nominated by Trump, Mr. Kevin Warsh, is going to pitch in. Now the insider news or whatever internal news which we could collect is that Kevin is not going to be so conservative like Jerome Powell. He is going to bring in something called financial repression. So what all you will learn in this? What is financial repression? How is it used to cut down the debt of a country? Here we will talk about US. What is yield curve inversion? How is it related to a recession? What is the relation between financial repression and yield curve inversion? We as investors, how will we shield ourselves from this probable recession and financial repression and the aftermaths of this financial repression? And how will we save our portfolio and still create sensible profit even under this immense economic pressure? So let's get into it. So if you see war has large spending. So these days, lesser tax collected, large spending leads to higher national debt. That's what has happened to US as well. So this $39 trillion. But if you see, it's totally different story that this war has been brought into place so that the US dollar dominance is in place so that he will not lose its petrodollar or dollar dominance, so that his debt, even though it is high, it is still manageable. So basically there are 4 probabilities by which the US debt can be resolved. One is like borrow large amounts of money just by again floating bonds and then service the old bonds, which is the debt. Basically US takes debt by releasing bonds. They float bonds. It is bought by Japan, China, Federal Reserve himself, and within the country and external investors as well, and they raise the fund, and that fund is used for their spending, inclusive that of war, military spending, internal capex requirements, etc. So this they can float newer bonds, newer treasury bills, and then raise money and pay for the last outstanding debts. But this is like funding or paying a credit card using another credit card. So this is not a feasible option. Another thing is that double the taxation. So increase the taxation on US citizens and bring more, or maybe increase the tariff on countries like India, etc., wherein if really we do trade with them, then the taxation is applicable and they will make enough income and they can repay their debt. This is also not feasible because you have seen that Trump has increased tariff up to 50% and come back to lower levels because countries are resisting against this and they are going for newer alternatives, which will not be good for US. So it is also not a practical option. Third option is default on debt. So tell that I will not be able to pay the debt. So the US dollar dominance will be gone. USD will fall like anything, and there will be huge meltdown. Global banking system will melt down. US dollar will go to such low levels and it will not be anymore a favorable trading currency. So this is also not a feasible option. The last and most feasible option is soft default. So that is nothing but through financial repression. So what is financial repression? It is a quite silent tool or policy incorporated by a government of a country, to reduce its debt burden by manipulating the financial system in their favor at the cost of savers and mainly bond investors, people who are investors who are invested in bonds, the treasury bills and the bonds floated by the US government, or well, in that case, the government of that nation. Financial repression is never declared in public, but then it is so much real. Financial repression is a strategic debt reduction strategy wherein the government quietly reduces the debt burden, as I told, by manipulating the complete financial system. You will never know about that, but then they have done it numerous times, especially US government has done this many times. I'll further explain you in this video. So what happens in this financial repression? The government ensures, along with the central bank and the government, ensures that the interest rate artificially stays very low. It will be capped at some rate and inflation stays so high, at least at moderate levels. So high inflation, low interest rate. So what happens in this? The money you are having, the retailers like us, we are having, the FD investors or conservative investors like us, we are having, we lose value of that faster than it grows. So if you see, interest rate is what you earn and inflation is what you lose. So inflation is like 100 rupee today. So inflation is 5%, means it becomes 95 rupees next year. So it keeps on reducing in value to the percentage of inflation, whatever it is for the particular year on year. And interest rate is what? It is basically the repo rate in case of RBI, or in case of Federal Reserve, it's Fed rate. So they have some rate, and above that amount, the banks apply some spread which is 2.5%. So repo rate is 5.5, means another 2.5% they add. So 8% is the rate at which the bank gives you a home loan, and also the FD rates. So they give a spread of 1.5 to 2%. So FD rates are around 6.5%. So you get a interest rate on your FD as well. So if the inflation is so high and the FD returns from fixed income returns like FD is very low, so you have to spend more because of inflation, but your money grows at a lower rate in your FD. So you will feel the pinch. So what US is trying to do through financial repression is that whatever debt is having, because of this lower interest rate, the debt repayment burden is less, because higher interest rate means they have to pay, like, to give you an example, 1% interest rate costs US around $300 billion of interest payment. So 1% less means 300 billion saved. So total 1 trillion payment. So 300 billion gone means 700 billion is the interest payment. 1% interest rate is cut. So they are trying to cut the interest rate. So they have some rate, and above that amount, the banks apply some spread which is 2.5%. So repo rate is 5.5, means another 2.5% they add. So 8% is the rate at which the bank gives you a home loan, and also the FD rates. So they give a spread of 1.5 to 2%. So FD rates are around 6.5%. So you get a interest rate on your FD as well. So if the inflation is so high and the FD returns from fixed income returns like FD is very low, so you have to spend more because of inflation, but your money grows at a lower rate in your FD. So you will feel the pinch. So what US is trying to do through financial repression is that whatever debt is having, because of this lower interest rate, the debt repayment burden is less, because higher interest rate means they have to pay, like, to give you an example, 1% interest rate costs US around $300 billion of interest payment. So 1% less means 300 billion saved. So total 1 trillion payment. So 300 billion gone means 700 billion is the interest payment if 1% interest rate is cut. So they are trying to cut the interest rate and keep the inflation high. So what happens? The burden of debt is transferred from the country level to the common man, which is nothing but the US citizens. So they will feel the pinch. Say for illustration purpose, if the interest rate is 5% and the inflation rate is 7%. So 5 minus 7 is the real returns you get. So 5 minus 7 is how much? Minus 2%. So whatever capital you are having, you will lose 2% every year if this is the case. Now as the inflation further increases and interest rate further decreases, the difference increases, and if it becomes -3 means you lose more. So you are losing, but who is gaining? The government is gaining. On what? Their interest payment and their debt burden. So they are reducing that at your cost. And also another thing is that if interest rate is low, so obviously the inflation is high, because if interest rate is low, the borrowing is done by various people and the spending increases. So spending increases means inflation increases. So more spending, more goods and services are produced by the country and more GDP. So higher GDP means the debt burden is reduced because of the lower interest rate, and also the GDP increases due to this consumption theme. So numerator GDP increases, denominator debt reduces, so the debt to GDP ratio drastically reduces. This is through financial repression. Though this increase in GDP is not really through good productivity, but then economically this makes sense in reducing the debt to GDP ratio. Also, as I told in my last video, as the interest rate reduces, the purchasing power of the people reduces because they get lesser returns. So to get higher returns, the bond investors, the bond holders, for the new bonds, they will demand higher yield, higher coupon rate. So short-term bonds, which is having shorter duration. So the government is forced to offer higher interest rates, higher coupon rate for the bond, and the long-term bonds become less attractive, lesser coupon rate. So long-term bonds will have lower yields compared to short-term bonds. So this scenario is called yield curve inversion. Normally, the long-term bonds will have higher yield because there is a risk of like after 10 years what will happen, nobody knows. So because to take that risk, to build confidence in investors, the yield is higher as the bond duration increases. But then because of this debt issue and economical fear, people tell that for shorter duration, I want higher yield. So this happens in case where there is less visibility on future of the country. So interest rates become lower. So from this, because of the short-term yields are higher and the long-term yields are lesser, this will lead to a yield curve inversion. So normally a yield curve inversion is told to be a predecessor to economic recession, a recession of a country. But then in this case, this is not a natural phenomena. The manipulation is happening. Like I told, financial repression is a manipulation, financial system manipulation by the government by reducing the interest rate and increasing the inflation artificially so that they get out of the debt burden. So this conflicts the concept that all yield curve inversion are not predecessors of recession. So here the yield curve inversion is happening, if you ask me, because of this financial repression to get out of the debt, not because the recession is immediately coming. Hope you understand this concept. So who impacts from this financial repression? Conservative, so-called conservative fund holders like FD holders, safe return investors. So these people will suffer because FD rates go so low and they are not invested in real assets but in FD. So interest rates goes down means the FD returns reduces and the inflation is high. They will really feel the pinch of managing their expenses. And who will benefit from this? First, government. Government of that country is the best beneficiary. Then the borrowers, say investors like us, wherein we borrow and invest. So we get it at a cheaper rate as the interest rates are low. The borrowing cost reduces, even though FD rate reduces, so is the borrowing cost. So I will get loan, even personal loan, home loans, everything at a lower rate. So real estate investors, then stock market investors, then mutual funds, all these organizations, real asset holders will benefit because their borrowing becomes cheaper. And even the entrepreneurs, the businessmen, they can expand their business because they are getting cheaper loans at cheaper lending rates. Now whatever concept I am explaining here, financial repression, I am not imagining this is going to happen because this has earlier happened as well. As soon as World War II ended in late 1945, where the debt to GDP ratio of US had risen to as high as 119%. Now it is much more than that. Then it was 119%, wherein the inflation was as high as 6% and the interest rate was reduced as low as 3.5%. So 3.5 minus 6, so almost minus 2.5% was the real return. So this is a typical case wherein US government brought in this financial repression almost for a decade, 10 years they did this, and they brought down the debt levels. So this is at the cost of the common conservative investors, but then this is an effective way of reducing the debt. Note that in this only normal common people gets locked. Investors, rich people, the 1% club always benefits. So how does the central bank and the government execute this beautifully? They keeps the interest rates so low, and yes, these interest rates are low means the investors will not be investing in bonds, right? Because the yields are less and they will go for better places of foreign currency, external investments like India, emerging market. They can invest in emerging market and they can make more returns. But then government will not allow this. You can see in India FII outflow. Why this is happening? This is all a play wherein the government is creating barricades or regulatory constraints to banks and pension funds and other large institutions, wherein they tell that liquidity has to be maintained with the central bank. So they tell the banks that some liquidity ratio has to be maintained. So you must buy the bonds, US treasury bills, treasury bonds, and fund the US because if you don't buy this, then liquidity ratios are not maintained. And even though these bonds are less attractive, they give very low yield, but still they are forced to invest there. So that is why you can see FII outflow from India. These are all the part of the game. So they control the capital of these investors or investment firms. So this is at the cost of pension funds and 401k or other retirement schemes of various employees. So they are forcing those institutions to invest in bonds which are lower yield. If they had invested in countries like emerging markets like India or other Asian countries, they would have got higher yields, higher returns. The retirement fund would have been larger for the US citizens. But then because of this agenda, this is not happening. Even the institutions, the government forced the institutions to rate various bonds at AAA, even though it is not AAA. They are forcing organizations to rate it AAA so that AAA or AA, whatever it may be. So higher rating means the bonds are trustable and you can invest in them. Though US economy is underlying is completely fallen, high debt and all, but still because of this manipulation, financial system manipulation, the investment is going to wrong places. So we as investors, the takeaway here is that don't over rely on low yielding bonds or FD investments. These are never an investment. And also invest in emerging market and stocks wherein the businesses grow and businesses borrow. The interest rate becomes cheaper means the businesses borrow more and expand their businesses using large capex, because cheaper lending rate means they have higher profitability. So invest in businesses, invest in pieces of businesses which are stocks, and if you are busy then you can invest through mutual funds as well. But then don't be so conservative like invest in FD or low yielding bonds wherein you will erode your wealth and not even beat the inflation. That's why rich people never save, they just borrow, they use other people's money to grow their business. That's nothing but the lower interest rate, lower borrowing cost, borrow more, grow the business, earn more. Hope this session was clear to you. Any comments, please feel free to comment in the below comment box. See you next video. Till then, happy investing.